There is this very specific, almost universal feeling. I think anyone who has ever dabbled in the markets knows it intimately.
Oh, yeah. The end of day realization.
Exactly. It usually happens right around the end of the day, maybe, just after the closing bell.
Right.
You are just sitting there. You're staring at your trading screen. The glow of the monitor is like reflecting off your face, and you're just looking at this absolute chaotic mess.
A massacre of red and green arrows.
Yes, just plastered across your chart. You're looking at entries that make absolutely zero sense. Exits that you clearly took in a state of sheer terror.
I've been there. We all have.
And your profit and loss statement just looks like a casualty report. And you just think to yourself out loud, the empty room, what was I even thinking?
It's a really sobering moment, right? Because it's this realization that the rational, highly analytical person who sat down at that desk at 8 in the morning.
Put the coffee in the perfect plan.
Right. With a pristine, meticulously back-tested plan. That person has somehow, over the course of just 8 hours, been hijacked.
Completely replaced.
Yeah, replaced by someone totally unrecognizable. It's basically a Jekyll and Hyde scenario, but, playing out across candlesticks.
That is such a good way to put it, because the distance between that perfect 8 a.m. plan and that 4:00 p.m. disaster, it isn't a lack of intelligence.
No, not at all.
It's a lack of a single specific psychological muscle. Because at 8 a.m., you had it all together. You had your support levels drawn, your order flow zones mapped out.
Your risk-reward ratio is calculated down to the exact decimal.
Exactly. It was architectural. But then the market opens.
And the numbers start flashing.
Right. The numbers flash. There's a sudden liquidity grab here, a massive momentum spike there. And suddenly that beautiful blueprint is just out the window.
You're just clicking the mouse in pure panic.
Pure, unadulterated panic. And, the most painful part of that scenario isn't even the financial loss.
I mean, the capital drawdown hurts, certainly.
Sure, losing money hurts. But the true agony is the psychological toll. It's that internal monologue dissecting your failure.
That voice saying, if only I had followed my rule.
If only I was disciplined.
Yeah.
If only I just sat on my hands and been patient.
That gap between knowing your edge and actually executing it in the heat of the moment, that is the great divide in trading.
And bridging that divide is basically the sole mission of this deep dive today.
Yeah.
We are unpacking the patience strategy.
It's the core of everything.
We're going to isolate that psychological edge, that invisible, often agonizing, but absolutely essential quality that separates the consistently profitable from those perpetually chasing their own tails.
And we've brought together a really formidable stack of source materials to do this.
We really have.
Yeah.
So what are we looking at today?
Well, we're looking at performance coaching frameworks from FTMO and Kinesis Money. They have done extensive work on the psychological architecture of the trader.
Love FTMO's stuff on this.
It's great. We're also pulling technical breakdowns from FexView and Trade Pro Academy. That's going to help us see how these mental breakdowns actually manifest mechanically on order flow charts.
Right. Getting into the actual candles.
Exactly. And to cap it off, we are utilizing a masterclass from Mihai Aikub on TradingView.
Which is intense, by the way.
Extremely. It provides a literal, grueling workout routine to build this psychological muscle.
So for everyone listening, this deep dive isn't just theory. We are going to dissect real charts, Bitcoin and gold, and break down the exact mechanisms of impulsive versus patient trades.
Tangible, actionable stuff.
We want to give you a toolkit to stop chasing the market and start letting the market come to you. So where do we start?
Well, the overarching theme across all these sources is a fundamental re-education of what patience actually means, specifically in the context of high-stakes environments.
Because it's different from everyday patience, right?
Totally. Before we even look at a single moving average or liquidity pool, we have to look at the neurobiology and psychology of the trader.
Right into the brain.
Yeah, because when the market is accelerating, when volatility is expanding, and you have tangible capital on the line, doing nothing feels incredibly counterintuitive.
It feels wrong.
It feels like a literal threat to your survival.
It physically hurts. I mean, it feels like you are missing the boat and your brain is just screaming at you that inaction is a failure.
And that visceral discomfort is exactly what the FTMO coaching materials address right out at the gate. They force a complete redefinition of the patient strategy.
How so? Like, what's the amateur view versus the pro view?
So the amateur views patience as waiting around. Like it's this passive, weak state of being. You're just sitting there bored.
Like you're missing out on the action.
Exactly. But FTMO frames it as an active, aggressive, conscious choice. You are actively choosing to prioritize long-term statistical edge over instant dopamine gratification.
Wow. Active aggressive defense. I like that.
And they categorize this active patience into 3 distinct operational phases.
Okay, let's break those phases down. Because I imagine it's not just about waiting for a 5-minute candlestick to close.
Oh, it's far more nuanced than that. The first phase is waiting for the right setup.
Okay.
This means refusing to engage with the market simply because you are bored or, you desire action. It requires waiting for your specific, predefined technical and fundamental criteria to align perfectly.
So just flat out refusing to play unless the rules are met.
Right. Now, the second phase, which many argue is actually significantly harder, is waiting in the trade.
Oh, yeah. Letting your winners run.
Letting them run to their intended targets, not snatching a fractional profit simply because your heart rate spiked during some minor pullback.
Just trusting the structural analysis to actually play out is so hard.
It is agonizing. And then the third phase is waiting for progress. That's the macro view.
Like account growth.
Exactly. Understanding that statistical edge and account growth are realized over a sample size of like hundreds of trades. You don't get rich by hitting a home run by Tuesday afternoon.
Right. It's a marathon. And the psychology behind why these 3 phases are so difficult is what fascinated me in the FTMO source.
The ego states, right?
Yes. They utilize this framework from transactional analysis. They break the trader's mind into 2 distinct operators: the child ego state and the adult ego state.
It's a brilliant framework.
It really is. When you read about the child ego state, it perfectly explains that 4:0 p.m. feeling of looking at a ruined chart.
Absolutely, because the child ego state is the emotional epicenter. It operates entirely on feeling, impulse, and the immediate environment.
Just reacting to shiny objects.
Pretty much. It craves excitement. It desperately wants a feeling of control over the market, which is an illusion, of course. And most dangerously, it demands instant gratification.
So when the market is slow, the child throws a tantrum.
Exactly. When you are staring at a chart that is just consolidating, moving agonizingly sideways in a tight range, the child ego state perceives that lack of stimulation as a problem to be solved.
It's that inner voice whispering, we have to do something. We can't just sit here. The market is open. We need to have risk on the table.
Yes! Let's push a button.
It makes me think of like an amateur surfer out in the lineup. Have you ever seen that?
Oh, sure. Paddling at everything.
Exactly. The child ego state is that guy who is just furiously paddling at every single tiny ripple in the water. He's bored, he wants to surf, so he just burns all his shoulder strength trying to catch chop that has absolutely no underlying energy.
He's exhausting himself for nothing.
Right. And then when the actual 6-foot set rolls in, the real wave with actual power behind it, he's too gassed to catch it. He missed the actual opportunity because he couldn't tolerate the stillness of the water.
That analogy highlights the opportunity cost of impulsivity beautifully. Because the counterpart to that surfer, the adult ego state, is the veteran surfer who actually understands oceanography.
The one just sitting out the back, chilling.
Exactly. The adult ego state is the rational, prefrontal, cortex-driven part of the brain. It can tolerate ambiguity. It can tolerate uncertainty.
It doesn't need the constant dopamine hits.
No, it doesn't. It processes decisions based on historical probabilities, statistical distribution, and a rigid, predefined plan. It entirely strips emotional interference from the execution.
The adult recognizes that the big wave is inevitable, right?
Yeah.
So they aggressively conserve their capital and their mental capital for that specific moment.
Precisely.
But let's dig into the friction here, because this is what always gets me. If we rationally know we need to be the adult, if we know we should sit on our boards and wait for the set, why does doing nothing trigger such a severe stress response?
It's a great question.
I mean, sitting at a desk doing nothing shouldn't induce a cold sweat. Yet for a trader, it absolutely does.
It really comes down to evolutionary biology and how our brains misinterpret the financial markets.
Misinterpret? How so?
Well, in a high-stakes, rapidly changing environment, your primitive brain interprets inactivity as a failure to defend yourself.
Oh, wow. So it feels like vulnerability.
Yes. You are watching numbers tick up and down.
Right.
And these numbers represent your livelihood. So your amygdala is firing, telling you that if you aren't taking action, you are a victim of the environment.
You're just waiting to be eaten by a lion.
Basically, yeah. And the FTMO materials offer this really crucial cognitive reframe for this specific biological trap. It's so simple, but profound, they say. Doing nothing is not nothing.
Doing nothing is not nothing. I feel like that needs to be framed above every trading desk.
It really is the ultimate paradigm shift.
Yeah.
When you are sitting there gripping the mouse, consciously overriding the urge to click buy because your moving averages haven't crossed yet. You are not being passive.
Right. You're actually working really hard.
You are engaging in an active, highly aggressive defense of your capital. Every single suboptimal, impulsive trade you refuse to take is capital preserved for the A-plus setup.
So reframing the wait as an active defensive maneuver helps satisfy that primitive brain's demand to do something.
Exactly. You are doing something. You are actively starving the market of your money until it meets your terms.
Okay, so if we know the psychological traps and the neurobiology working against us, how does this actually translate to the mechanical reality of trading?
You mean on the charts?
Yeah. What does this sabotage look like when it hits the order book? The Trade Pro Academy source provides a phenomenal breakdown of this. They compare two hypothetical traders navigating the exact same market conditions.
Oh, this case study is incredibly illuminating because it isolates the psychological variable by holding literally everything else constant.
Right. Same market, same tools.
Exactly. We have Trader 1 and Trader 2. Both are trading the S&P 500 futures market. Both are using the exact same technical system.
Okay.
Crucially, they both have the exact same order flow pivot levels drawn on their charts for the day. It's a completely level playing field.
And just to clarify for the listener, when TradePro talks about these order flow pivot levels, mechanically we're talking about specific price zones where massive institutional liquidity is resting. Right?
Oh.
These are areas where major buyers or sellers have trapped volume, or where large clusters of limit orders reside. And the space between these levels is essentially a liquidity vacuum.
Precisely. The pivot levels are the structure. The space between is just noise.
So what happens when the bell rings?
Let's look at Trader 1 first. Trader 1 is operating almost entirely from the child ego state.
The paddler.
The paddler. So Trader 1 sees the designated support and resistance zones. But as the session opens, the price is fluctuating wildly between those zones. It's dipping, it's rallying, it's chopping around.
Just standard opening volatility.
Yeah. And Trader 1 is immediately infected by FOMO. They see a rapid green candle pushing up into that vacuum between levels, and the internal monologue just screams, I have to buy this momentum right now or I'll miss the entire run to the resistance line.
So they're throwing the plan out the window in the first 10 minutes?
Within minutes, yeah.
They're jumping into the vacuum where the price moves the fastest, which visually triggers the excitement. But it's also where the order book is thinnest and most erratic.
Exactly. They take the trade in the middle of nowhere, and because it's a vacuum, the price instantly chops back down, stopping them out.
Naturally.
Frustrated, they reverse their position and go short, and they get chopped up again. Over the course of the trading session, Trader 1 executes 16 sporadic, entirely unplanned trades.
16.
They are buying minor dips out of panic, entering late on micro trends, just constantly clicking to feel in control.
Trying to catch every ripple.
Let's look at the math on this. Assuming a rigid 3-point stop loss and a 5-point take profit on the S&P, out of those 16 trades, they might scrape together 5 winners purely by chance.
Okay.
But they suffer 11 losers.
5 wins, 11 losses. And if you pull up their chart at the closing bell, it is just a massacre of entry and exit markers.
Yeah.
Completely ignoring the beautiful, logical order flow lines they drew that morning.
It is visual chaos. And the Trade Pro analysis points out the fatal flaw here. Trader 1 wasn't actually analyzing the market, they were just chasing the footprint of the price.
They were reacting to the symptom, not the cause.
Exactly.
The irony is almost painful. Because by trying so desperately to capture every single micro fluctuation, Trader 1 mathematically ensures they are always entering late.
How so?
Well, because they wait for the visual confirmation of a fast candle in the vacuum, right? By the time their brain processes it and they hit execute, that micro trend has already exhausted itself.
Right, because it was just noise anyway.
They are perpetually buying the absolute top of the chop and selling the dead bottom. They are just feeding their capital directly to the algorithms that prey on retail traders.
Entering late, chasing the tape, abandoning structural confirmation, it's a disaster. But, the FexView source points out that this impulsive behavior can actually mutate into something even more destructive.
More destructive than losing 11 trades.
Yeah, the overconfidence wipeout.
How does impulsivity breed overconfidence? Usually losing 11 trades humbles you pretty quickly.
True, but it's the scenario where the impulsive trader actually gets lucky. Imagine Trader 1 takes 3 of those terrible, unplanned trades in the vacuum, and by sheer variance, just pure luck, they all hit the take profit.
The worst thing that could happen to a beginner.
Exactly. The child ego state receives a massive rush of dopamine. It feels validated. The brain wires a connection that says, I don't need the plan. I have an intuitive feel for the rhythm of the market today.
Oh, that is the most dangerous sentence in trading. I have a feel for the market.
It is lethal, because once the plan is abandoned, risk management is the very next thing to go.
Naturally.
On the fourth impulsive trade, driven by greed and this false sense of invincibility, they massively increase their position size. They are over-leveraged in a suboptimal setup.
And then reality hits.
Inevitably, the variance normalizes. The market snaps back to structure. The position instantly goes offside, and because the size is too large, the account suffers a catastrophic, unrecoverable drawdown.
Wiped out.
They get wiped out in a single afternoon, and not because their original system was bad, but because they lacked the patience to let the system work.
Okay, now contrast that entire horror story with Trader 2. We have the same S&P 500 chart, same order flow liquidity zones. What is Trader 2 doing while Trader 1 is blowing up their account in the vacuum?
Trader 2 is sitting in the adult ego state, practicing active defense. They watch the price violently chop around between the levels.
Do they feel the FOMO?
Oh, they feel the exact same biological urge to jump in as Trader 1 does. The adrenaline is absolutely there, but they consult the plan.
And what does the plan say?
The rule is binary. It says, only execute when price touches the predefined pivot level. So they sit on their hands.
And if it's excruciatingly boring.
It is deeply tedious, but they wait. Finally, hours later, the price exhausts itself in the vacuum and pushes down into the major support zone, the pivot level.
The zone they drew at 8 a.m.
Yes. Trader 2 executes one precisely calculated trade with defined risk. Over the entire session, they maybe take 3 trades total.
And the result of that boredom?
A pristine chart, a highly positive expectancy curve, and honestly, a completely intact nervous system.
They force the market to come to their predefined areas of structural interest rather than running out into the crossfire to chase it.
Exactly. Trade Pro makes a point that is hard for many to swallow. Professional trading is supposed to be incredibly boring.
Boring.
Yes, it is administrative. It is the systematic execution of a probability model. If your heart is pounding, if you are sweating, if you are feeling a rush of adrenaline, you are gambling. You are not trading.
That is a harsh truth. But
Right.
if we want to truly internalize this, I think we need to scale it up.
From intraday to macro.
Yeah. It is one thing to look at an intraday S&P 500 chart and talk about minute-by-minute patience. It is entirely another to look at macroeconomic patience that spans months or even years.
Oh, absolutely.
Let's look at the historical charts for gold and Bitcoin from our sources, because they perfectly illustrate the mechanics of waiting for a setup versus waiting in a trade.
Let's begin with gold. We'll use the breakdown from Kinesis Money for this. This is perhaps one of the greatest historical case studies in long-term discipline.
Okay, paint the picture for us.
To visualize this, we need to step back and look at a monthly chart of gold. Each single candlestick represents an entire month of price action. It smooths out all the daily noise.
So we are looking at the macro structural foundation of the asset.
Exactly. Coming out of 2002, gold formed a massive concrete base of support and initiated a multi-year secular uptrend. It was a beautiful chart.
It's up and to the right.
Up and to the right. But fast forward to 2011. In 2011, a critical structural event occurred. The price of gold broke decisively below that major multi-year ascending support line.
Oh, wow. That is a fundamental shift. The thesis that has held for nearly a decade is suddenly broken.
Yes. For any institutional player or serious trader, a break of a decade-long support structure is a blaring siren.
Right.
But the impulsive trader, the child ego state looking for a bargain, sees that massive drop and thinks something else entirely.
They think it's a sale.
Right. They think gold is incredibly cheap compared to last month. I need to buy this dip aggressively. It has to bounce back to the trend.
They are attempting to front-run the market's structural shift. They are catching a falling knife because they lack the patience to let it actually hit the floor.
Precisely.
So what does the adult ego state do in 2011?
The patient trader observes the broken support and accepts a harsh reality. The thesis has changed. We're no longer in a bull market. We have entered a high time frame corrective phase.
So what's the move?
They execute the most difficult maneuver in finance. They step aside.
They just do nothing.
They preserve their capital. And in the case of gold from 2011 onward, they had to wait for years. Gold entered a massive grinding, multi-year consolidation phase.
This brings up the concept of opportunity cost that kinesis money emphasizes so heavily.
It's a huge factor.
Because if you had surrendered to impulsivity and bought that initial dip in 2011, your capital would have been trapped in a decaying asset for over half a decade.
Yes.
You would have suffered the mental anguish of watching your portfolio stagnate while the rest of the equity markets were going on massive bull runs.
Capital allocation is a zero-sum game. Money trapped in a dead market is money that cannot be deployed into a trending market.
So true.
But the patient trader isn't just ignoring gold during those years. They are actively monitoring it, waiting for the structural narrative to shift back in their favor. They are waiting for what kinesis money calls the tick, tick, tick confirmation checklist.
Okay, I want to dig into the mechanics of this checklist because they aren't just looking at the price candle to guess when it's going up, right? They are waiting for underlying momentum to catch up to the price.
Exactly.
What were the specific items they needed to see to prove the trend actually had legs again?
It was a three-part mechanical confirmation.
Sure.
So first, during those years of consolidation, gold formed a new, lower horizontal resistance ceiling.
A ceiling it kept bumping its head against.
Right. So the first tick was waiting for the monthly price to decisively break and close above that horizontal ceiling.
Which proves buyers have finally overwhelmed the trapped sellers at that level.
Yes, that's tick one. Second, they waited for a crucial moving average crossover. The price had to cross back above both the 12-period and the 36-month moving averages.
Okay, which mathematically proves that the short-term momentum is now accelerating faster than the 3-year historical average. It's a literal shift in inertia.
Precisely. That's the second tick.
Yeah.
Now, the third tick was waiting for the price to break out above the Ichimoku cloud.
Let's pause on the Ichimoku cloud for a second, because it's often thrown around as a buzzword. But how does breaking the cloud actually confirm strength mechanically? What data is it plotting that those moving averages miss?
It's a really great question. While moving averages just plot historical closing prices, the Ichimoku cloud, specifically the space between the leading spans, plots a projected zone of equilibrium and volatility. It's based on historical highs and lows.
So it's more like a zone of friction.
Exactly. When price is inside the cloud, it indicates the market is in a state of high noise and equilibrium. It's a structural battleground.
It's choppy.
Very choppy. But breaking above the cloud means the asset has completely escaped that zone of historical friction and has a clear runway of momentum.
So only when all three of those complex mechanical conditions were met, the horizontal break, the momentum cross, and escaping the friction cloud, only then did the patient trader re-enter.
Yes. And the beautiful part is once all those confirmations aligned, a massive textbook cup and handle pattern became glaringly obvious on the macro chart.
The classic arc pattern.
Exactly. By waiting for the tick, 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 the trader avoided 5 years of dead money. They preserved their sanity, and they entered exactly at the point of explosive breakout, catching the historic run back toward $2,000.
They didn't try to predict the bottom. They forced the market to mathematically prove it was ready to trend.
That's the essence of waiting for the setup.
That is the ultimate masterclass in it. But let's shift to the second phase of patience. Waiting in the trade. Letting a winner run when everything inside you wants to secure the profit.
Oh, this is where it gets really painful.
The Exodus Trading Talks source provides a pretty brutal example of this involving Bitcoin.
Yeah, this is a scenario that continues to plague crypto traders to this day. So the setting is December 2020.
Yep.
Bitcoin is experiencing massive institutional inflows. It goes on an absolute tear, smashing through previous resistance and hitting a brand new all-time high of $20,000.
A huge milestone.
The trader in our Exodus example correctly identifies this macroeconomic shift. They execute a brilliant position trade, buying in and riding the wave up to that $20,000 mark.
It's a perfect entry. They are sitting on massive unrealized gains. The thesis is playing out beautifully.
But then early January 2021 arrives, and the market behaves like a market that breathes.
Things don't go up in straight lines forever.
Exactly. After a massive vertical expansion, Bitcoin experiences a standard, healthy correction. The price dips a few $1,000s.
And the child ego state, terrified of losing its newfound wealth, completely takes the wheel.
Violently takes the wheel. The trader looks at the red daily candle, and sheer panic overrides logic. The internal narrative shifts instantly from institutional adoption to the bubble is bursting, it's going back to zero, I need to liquidate everything right now to protect my profits.
They entirely abandon the long-term structural thesis that got them into the trade in the first place.
And they hit sell.
So for anyone who doesn't remember the history of early 2021, what was the cost of that panic?
The cost was missing one of the most violent, life-changing bull runs in financial history.
Ouch.
After that minor January dip, Bitcoin blasted past $20,000, chewed through $30,000, and went on a relentless tear towards $60,000 over the subsequent months.
They missed the whole cycle.
The trader missed essentially the entirety of that macro cycle because they lacked the emotional capacity to tolerate a standard volatility swing.
Yeah.
They could not wait in the trade.
Okay, I have to push back heavily here.
Sure, go ahead.
Because this is where the theory always breaks down in reality for me. Trusting the thesis in crypto sounds incredibly noble until you are riding a coin all the way down to a 99% loss.
Fair point.
I mean, look at the Terra Luna collapse. Look at FTX. Millions of people trusted their thesis all the way to personal bankruptcy.
True.
So how is the adult ego state supposed to differentiate in real time between a healthy temporary dip and a fundamental catastrophic collapse of the asset? How do you know when to be patient and when to run for the exits?
That is the exact friction point that separates amateur holders from professional position traders. It is arguably the hardest question in finance.
So what's the answer?
The Exynos expert addresses it through a very specific framework called objective invalidation.
Objective invalidation.
The difference between strategic patience and suicidal stubbornness relies entirely on knowing exactly what conditions would prove your initial thesis objectively wrong.
So it's not about how far the price drops, but why it drops. Explain objective invalidation a bit more.
Right. When you enter a position trade, you do so for a concrete technical or fundamental reason. Perhaps you bought Bitcoin because it broke above the 200-day moving average, and the fundamental thesis was that a specific regulatory ETF approval was imminent.
Okay, that's the thesis.
If the price drops 15% due to generic market deleveraging, but the price remains above that 200-day moving average and the ETF application is still progressing, your thesis is entirely intact.
The dip is just noise.
Exactly. You must exercise patience.
Because your reasons for being in the trade haven't changed, so your position shouldn't change.
Exactly. However, if the price crashes violently through that 200-day moving average, effectively breaking the macro market structure, or if the SEC outright rejects the ETF, then your foundational thesis has been objectively invalidated.
It's broken.
In that scenario, patience is no longer a virtue. It is a liability. You don't hold and hope. You execute your hard stop loss and you exit.
Ah, I see.
The trader in the 2021 example panicked, not because their thesis was invalidated, but simply because the unrealized profit number on their screen got slightly smaller. They let P&L dictate their actions rather than market structure.
Which highlights a fascinating point from the Exynos materials. Position trading, like holding assets for weeks or months, is widely considered to be easier than day trading because you weren't staring at a screen all day.
Right, that's the perception.
But psychologically, it might actually be far more agonizing.
It requires an ironclad nervous system. When you scalp intraday, you take your profit or loss in minutes. You get closure.
You can sleep at night.
Exactly. When you position trade, you have to watch your net worth fluctuate by tens of thousands of dollars for weeks on end. You're enduring news cycles, weekend gaps, and violent liquidations, all without touching the mouse. It requires a level of emotional detachment that is incredibly difficult to sustain.
Which brings us to a really harsh physiological reality.
Yeah, right.
Willpower is finite.
It absolutely is.
You can tell yourself all morning, I will be the adult ego state. I will trust the structure. I will ignore the P&L. But as the hours drag on, as decision fatigue sets in...
And the visual stimulation of the chart wears down your prefrontal cortex.
Exactly. Your willpower depletes. We cannot simply rely on sheer mental fortitude to survive these markets. We have to outsource our discipline. We need to physically engineer our environment to make impulsivity impossible.
Yes.
So what does the practical toolkit for systematizing patience look like?
This is where we transition from philosophy to mechanics. The sources, specifically Exynos and FTMO, outline concrete systems to protect you from yourself.
Okay, lay it on us.
The foundational step in systematizing patience is to brutally eliminate market noise.
Brutally eliminate noise. How do we mechanically do that?
By drastically reducing the number of instruments you track. A classic symptom of the hyperactive child ego state is having 6 monitors running 30 different charts.
Watching exotic cross-currency pairs, volatile altcoins, random commodities simultaneously.
Right. It guarantees overstimulation. And guarantees you will eventually find some low probability reason to click a button. The Exynos expert mandates sticking to a highly curated watch list. They specifically recommend the Forex majors, like the euro to US dollar pair, year USD.
I want to understand the mechanics of why the majors are safer. It's not just about them being popular, right? It's about how liquidity absorbs shocks.
Exactly. The Forex majors have the deepest liquidity pools in the world. Deep liquidity acts as a shock absorber.
Okay.
When you trade exotic pairs, say the South African rand against the Japanese yen, the order book is really thin.
There aren't as many buyers and sellers.
Right. So during a high volatility news event, the spread, which is the literal gap between the highest buyer and lowest seller, can widen violently. This spread widening can trigger your stop loss, kicking you out of the trade, even if the actual price structure never broke.
Wow. So you get stopped out purely by the mechanics of a thin market, not because your analysis was wrong.
Precisely. By sticking to highly liquid majors, you ensure tight, stable spreads. You remove a massive mechanical variable of uncertainty,
And less mechanical uncertainty means less cortisol spikes.
which makes it significantly easier for the prefrontal cortex to remain engaged and patient.
Okay, so we've curated our environment.
Yeah.
We're only watching one or two highly liquid charts. What is the next mechanical system to enforce patience?
It is the absolute ultimate weapon against emotional interference, the set it and forget it methodology utilizing pending orders.
Set it and forget it.
Yes. The most effective way to stop yourself from mismanaging a trade in real time is to completely remove your ability to execute it in real time. You abandon market execution entirely.
Okay, explain the difference in workflow between a market order and a pending order for those who might not use them.
Sure. A market order is reactive. You see a candle moving, you panic, and you click buy at whatever price the broker gives you right that second.
The child ego state loves market orders.
Loves them. A pending order, on the other hand, is proactive. You perform your deep analysis when the market is closed or quiet. You determine, based on order flow, I want to buy USD, but only if it drops exactly to this specific liquidity pool at 1.0850.
Okay.
You input a buy limit order at that exact price. You simultaneously input a hard stop loss order below structural support to mathematically cap your risk, and a take profit order at your target.
And then the most important part.
You take your hands off the keyboard, push your chair back, and physically leave the workstation.
You literally walk away.
You let the broker servers assume the responsibility of execution. If the market never drops to your entry price, the order never triggers, you miss nothing, you lost nothing, your capital is safe.
And if it does trigger,
If the market does hit your entry, the trade manages itself from start to finish. You don't have to watch the microscopic ticks feeling your blood pressure rise and fall with every fluctuation. You have effectively outsourced your discipline to a computer.
But what about the scenario from the Bitcoin example? Let's say your pending order triggers, the trade goes massively into profit, and you want to let the winner run to capture a macro trend.
Right.
But you're terrified of a flash crash wiping out your gains.
Right.
How do we systematize holding a winner without suffering constant anxiety?
That is the exact purpose of the algorithmic trailing stop, which FTMO heavily advocates.
Okay, trailing stops.
The child ego state wants to close the trade immediately to secure the dopamine hit of a realized win. The adult ego state wants to ride the trend to its mathematical conclusion. The trailing stop is the mechanical compromise.
Walk us through the mechanics of how a trailing stop actually trails the price.
You set a command in your terminal that says, keep my stop loss exactly 50 pips behind the highest price reached.
Okay.
So as the market trends upward, the stop loss automatically ratchets upward behind it. It acts as a safety net that follows the climber up the wall.
And if it pulls back a little?
If the price pulls back 20 pips, which is a normal fluctuation, the stop loss stays in place, giving the trade room to breathe. But if the market violently reverses and drops 50 pips, the stop is triggered, locking in the accumulated profit.
It completely removes the emotional agony of trying to manually guess the top of a trend.
Exactly. It does the heavy lifting for you.
You know, listening to this, it becomes so apparent how media completely misrepresents this profession.
Oh, totally.
You watch movies about Wall Street, and
Yeah.
trading is depicted as this adrenaline-fueled, high-octane war zone. People screaming into phones, slamming desks, making gut instinct decisions in a fraction of a second.
Hollywood loves the child ego state.
They really do. But listening to the FTMO and Trade Pro frameworks, the actual objective of a professional trader is to make the act of trading as unimaginably boring and mundane as humanly possible.
The paradox of trading is that excitement is inversely correlated with profitability.
Wow. Say that again.
Excitement is inversely correlated with profitability. If you are feeling a rush, if you are exhilarated, you are almost certainly doing something wrong. Professional trading is essentially high-level data entry combined with extreme risk management.
Data entry.
It is deeply repetitive. You are waiting for the exact same 3 technical setups to manifest week after week, executing them flawlessly without emotion, logging the data, and repeating the process. It is factory work for the mind.
If you require entertainment and thrills, go to a casino.
Exactly. The financial markets charge an exorbitant fee for entertainment.
Okay, we know the psychological traps. We have the mechanical tools, pending orders, trailing stops, major pairs. But knowing the mechanics and actually possessing the emotional regulation to deploy them when the screen is flashing red are 2 entirely different things.
Very different.
Patience is not just a theoretical concept. It is a neurological pathway that must be built. If you want a stronger bench press, you get under the bar. If you want unshakable emotional regulation, you have to hit the trading gym.
I love this transition.
This brings us to our final and undeniably most intense phase of the deep dive. We are going to meticulously break down an actual rigorous workout routine for your prefrontal cortex. This is derived from Mihai Akab's masterclass on TradingView. 7 practical exercises to build patience.
This is where we leave theory behind and enter the realm of intense, uncomfortable practice.
Buckle up.
These are not suggestions. They are deliberate, stressful drills designed to rewire your default neurological responses. Let's break down the regimen.
Let's do it. What's exercise number 1?
Exercise number 1 is called the observer. This specifically targets the sheer physiological impulsivity, that burning need to click a button just because the market is moving.
Okay, how does the drill work?
You open your live trading platform during the most active hours of the market, say the New York Open.
When everything's flying.
Right. You set a hard timer for 2 solid hours.
Oh.
And the unbreakable rule is you are prohibited from placing a single trade. 0 execution.
Wow.
No matter what setup appears, no matter how perfect it looks.
2 hours of just staring at a moving chart. For an active trader, that sounds like absolute psychological torture.
It is engineered to induce a dopamine detox. Because while you are staring, you are actively journaling.
Journaling what?
You write down the exact physiological and emotional responses you are experiencing. The price is breaking resistance. My heart rate is elevating. I feel an overwhelming fear of missing out. I want to buy.
Tracking your own panic?
Yes. You also log your hypothetical impulsive entries. I would have gone long right here. And then you simply observe the outcome.
I imagine the outcome is usually quite humbling.
Invariably. You will watch as the vast majority of your hypothetical adrenaline-fueled entries immediately reverse and stop you out in the vacuum.
You realize you would have just lost money.
Over and over. The psychological benefit is immense. It forces your brain to decouple the visual stimulus of a moving candle from the physical action of clicking the mouse.
It breaks the link.
It proves to your subconscious that not every movement requires participation, and it drastically deepens your contextual understanding of price action without risking a single dollar of capital.
Okay, you survived the 2-hour detox.
Yeah.
What is exercise number 2?
Exercise 2 is the 1 trade per day rule. This is the ultimate cure for the hyperactive, over-trading child ego state.
Trader 1 from our earlier example needs this.
Desperately. You establish an ironclad parameter for your session. You are allotted exactly 1 single bullet for the entire day, 1 execution.
That's it.
That's it. If it hits your take profit, you close the platform. If it hits your stop loss, you close the platform.
The psychological shift there is fascinating. Because it introduces artificial scarcity.
Exactly.
If I know I only have 1 trade, I am absolutely not going to waste it on some mediocre C-grade setup just to feel some action. I'm going to guard that bullet until the absolute perfect macro-aligned A+ setup presents itself.
Precisely. It weaponizes scarcity to force meticulous filtering. You stop trading out of boredom and start trading purely on structural alignment. It radically improves the mathematical quality of your entries because the threshold for action is artificially raised to the absolute maximum.
Which leads perfectly into the 3rd exercise, which targets the critical moment of execution, the decision timer.
Yes. So let's say you are practicing your 1 trade a day. You see the A+ setup forming, the price hits your liquidity zone, the adrenaline surges.
Right.
The child ego state screams, execute now before it gets away. Instead of clicking the mouse, you trigger a 30-minute timer.
I have to pause here. 30 minutes.
30 minutes.
In the Forex or crypto markets, a 30-minute delay could mean the entire move has already happened and reversed.
That is exactly the point of the drill. If the opportunity was merely a fleeting, impulsive microfluctuation driven by algorithmic noise, it will be over in 30 minutes, and you will have saved yourself from a chaotic, low-probability trade.
And if it's a real setup?
If it is a genuine, structurally sound, high timeframe setup, the kind that produces sustainable, massive asymmetric returns, it will absolutely still be a valid, actionable setup 30 minutes later.
It sounds exactly like a refractory period in neuroscience.
How so?
When a neuron fires, it enters a refractory period where it physically cannot fire again for a set amount of time. You are artificially inducing a refractory period for your trading finger.
That is a brilliant analogy.
You are giving the body time to flush the cortisol and adrenaline out of the bloodstream so the prefrontal cortex can actually come back online.
During those 30 minutes, the biological stress response subsides. You transition from the panicked child back to the analytical adult. You have the mental clarity to systematically review your checklist. Is this actually in the trading plan? Is the risk-reward ratio mathematically sound?
And if it is?
If, after 30 minutes of cool, detached review, it still meets every parameter, then you execute. It is an incredibly powerful speed bump for emotional hijacking.
All right, what is exercise 4 in the gym?
Exercise 4 is the no trade day challenge. You select one specific day every single week, let's say Wednesdays, and decree that executing a trade on that day is physically impossible. Your platform is in read-only mode.
A mandated financial Sabbath.
Exactly. You are still required to sit at your desk. You still analyze the charts and mark up the order flow, but you utilize the session entirely for administrative development.
Doing the boring stuff.
Yes. You backtest new variables, you relentlessly review your trading journal from the previous week, you audit your risk management parameters, and at the end of the session, you confront your emotional state.
Did I want to trade today?
Exactly. Did you experience agonizing FOMO watching Wednesday's volatility? Was it physically difficult to abstain? This drill actively breaks the neurological addiction to constant market participation.
It proves you don't need to be in the market to be a trader.
It proves to your nervous system that you do not need to have risk on the table 24/7 to identify as a successful trader.
Breaking the addiction to the screen.
Yeah.
Which brings us to exercise 5, which expands on the set it and forget it mechanics we discussed earlier.
Yeah.
Mihai calls it the walk-away method.
Yes. Once you have done the heavy analytical lifting, you waited patiently for the setup, you executed the entry, your hard stop loss is placed, your take profit is set. The absolute most destructive thing you can do is sit there and micromanage the trade tick by tick.
Just staring at it.
The walkaway method dictates that the microsecond the order goes live in the market, you physically stand up and leave your physical workspace for a minimum of 1 to 2 hours.
You literally abandon the screen.
You walk out the door, you go to the gym, you read a book, you go for a walk outside. You let the market dynamics play out entirely without your observation.
Because your parameters are already set.
Your predefined mathematical risk parameters are locked in. Micromanaging a live trade almost universally leads to emotional sabotage, cutting a winner prematurely out of anxiety, or disastrously moving a stop-loss further away because you are hoping a loser will bounce back.
Walking away just completely severs that visual feedback loop that causes the emotional temptation.
It's the only way to be sure you won't meddle with it.
Okay, the first 5 exercises make total logical, neurobiological sense to me. But I have to push back incredibly hard on exercise number 6, the frustration tolerance drill.
I knew you would.
Because when I read the mechanics of this in the outline, it sounded completely unhinged. It sounds counterproductive to the entire goal of making money.
I completely understand the resistance. It is, without a doubt, the most psychologically agonizing exercise on the list.
Let me just explain it for the listener. The drill is, you sit at your screen, you patiently wait for a genuinely flawless setup, an A-plus, high-probability order flow setup that perfectly matches every single parameter of your plan. And then you deliberately refuse to take it.
Yep.
You just sit there and watch it play out perfectly without your money in it. Why on earth would I intentionally skip a mathematically perfect trade? That sounds like financial self-sabotage.
It feels like sabotage to the child ego state, sure. But to the adult ego state, it is extreme exposure therapy for FOMO.
Exposure therapy.
Think about it. The fear of missing out is the foundational root cause of almost all impulsive, destructive trading behavior. We suffer from a deeply ingrained scarcity mindset.
We think there won't be another wave.
Exactly. We are terrified that if we miss this one specific move, this one specific candle, we will never find another opportunity to make money again. The frustration tolerance drill forces you to confront that existential fear head-on and realize it is a complete illusion.
So you literally sit there watching the perfect trade hit your hypothetical take-profit target, and you just absorb the anger of leaving money on the table.
Yes, you observe the immense bubbling frustration. You document the anger in your journal. You write down exactly how painful it is. But then as the day progresses, you realize something profoundly liberating. The world did not end. Your trading account did not blow up. And most crucially, the sun comes up the next day, the market opens, and the chart presents another mathematically perfect opportunity.
You desensitize yourself to the pain of a missed opportunity.
Exactly. By surviving the intense psychological anguish of missing a perfect setup, you completely destroy the desperation that drives FOMO. You learn on a deep, visceral level that the market provides an infinite, unending stream of opportunities.
Wow.
Once your nervous system truly believes in that abundance, you will never feel the need to chase a suboptimal garbage trade again, because you know with absolute certainty that another perfect setup is always right around the corner.
That is incredibly intense. It's like staring directly into the abyss of your own greed and scarcity mindset. If you can survive that drill, standard trading must feel like absolute child's play.
It does. It really does.
All right, bring us home. What is the seventh and final exercise in the gym?
Exercise 7 is the trading plan repetition. This focuses on building subconscious, automated discipline. Every single morning, before you boot up your charting software, before you look at a single overnight price quote or read a single news headline, you take a pen and a physical notebook and you handwrite your core trading rules.
Handwrite them, specifically not typing them on a keyboard.
It must be handwritten. I will not execute a position unless price touches my predefined order flow zone. I will never risk more than 1% of my total equity on a single setup. I will explicitly use a hard stop loss on every execution.
Okay, why writing?
The neuroscience behind this is critical. Writing by hand engages the basal ganglia and fine motor skills in a way that typing does not. It creates deeper neural pathways and stronger cognitive reinforcement.
It sticks in the brain better.
Yes. By physically writing the rules every single morning, you are literally programming the parameters of the adult ego state into your subconscious mind before the emotional child ego state even has a chance to wake up and look at the charts.
It transforms conscious, difficult discipline into an automatic subconscious habit.
Exact.
The trading gym. 2 hours of dopamine detox observing. The scarcity of one trade a day, 30-minute refractory periods, mandated no trade days, physically walking away from the desk, extreme exposure therapy for FOMO, and daily handwritten neuroplasticity exercises.
That's a lot.
That is a grueling, exhausting regimen. But, as Mihai Aka points out, if you want the outsized financial results that 90% of retail traders fail to achieve, you have to be willing to do the psychological reps that they refuse to do.
It all synthesizes into a single, undeniable truth across all our sources today. Patience in the financial markets is not a passive personality trait you are simply born with.
No, it's built.
It is an active, aggressive, defensive strategy. It is the conscious, daily transition from the emotional, thrill-seeking, PNL-obsessed child ego state to the rational, probability-driven, structurally focused adult ego state.
It's waiting for the complex tick-tick-tick confirmation checklist like we saw on that massive Kinesis money goal chart. Having the discipline to step aside and avoid 5 years of dead money and opportunity cost.
And it is possessing the emotional fortitude to trust your structural invalidation criteria through terrifying pullbacks, unlike the trader who panicked and missed the historic Bitcoin run.
Trusting the structure.
It is recognizing that the algorithm's primary objective is to shake you out of your position, and your only viable defense is a systematized approach, utilizing limit orders, trailing stops, and treating your psychological discipline like a muscle that requires relentless, intentional training.
It has been a massive, intense journey today. From the neurobiology of why we self-sabotage, to the mechanical anatomy of an order flow trap, to the historical macro charts, and finally to a literal workout routine for our prefrontal cortex.
A true deep dive.
And I want to leave you, the listener, with a final thought to mull over as you boot up your screens tomorrow morning. We spend so much time and money in this industry obsessing over the perfect strategy. We search endlessly for hidden, proprietary indicators. We try to build faster computers, pay for faster data feeds, trying to shave milliseconds off our execution times to beat the algorithms.
Right.
But what if the ultimate trading edge isn't technical at all? What if your greatest competitive advantage in a market completely saturated with hyperfast AI trading bots, quantitative algorithms, and millions of panicked, over-leveraged emotional human beings? What if your absolute ultimate edge is simply your ability to sit quietly on your hands, tolerate the excruciating boredom, and do absolutely nothing until the market is forced to meet your exact terms?
It is the hardest edge in the world to develop, which is precisely why the market rewards it so disproportionately.
Now, we want to turn this over to you. We want to hear about your process. How do you mechanically or psychologically practice patience in the heat of a volatile session? Have you ever subjected yourself to any of these intense exercises, like the frustration tolerance exposure therapy or the 30-minute timer? Or do you have a unique custom method of your own to stop yourself from clicking buy before the setup is mathematically ready?
We want to hear it all.
Drop your experiences, your systems, and even your most painful lessons in the comments or share them with us online, because we read everything and we would love to dissect how you handle the wait. Until next time, keep your risk rigidly managed, trust your structure, and above all else, stay aggressively patient. This has been The Deep Dive.